Welcome to Total Return with Division 1 Finance. My name is Deron Forbes, and my goal is to help you improve your returns by keeping you up to date with everything that you need to know. We don't fall victim to marketing schemes of major institutions, and we don't settle for mediocre returns. What helps investors beat the market is information and the knowledge of how to use it. We will provide you with both. Be sure that you subscribe and turn on your notifications because every time we drop a new episode, money is made. As an investor, I quickly came to understand that one of the most important things you can do is keeping track of what's going on across the economy. Now, while everything seems to be working against us in the long term, in the short term, the tides are still currently in our favor. And why is that? Because manufacturing activity is signaling that demand is finally starting to slow. Manufacturing PMI reports today show the slowest growth in manufacturing since the second quarter of 2020. Manufacturers are now taking cost-cutting measures. They now see future demand as uncertain, and so employment rose only slightly on the latest report. These things lead to less demand for the dollar, expectations that the Fed may take a more dovish tone in December, and that's positive for stocks in the short term. Now, that's not all we need to look at for this latest manufacturing report. Here's some more key insights. Inflationary pressures ease yet again. Input prices and output charges softened. This could mean that the CPI and the PCE could deliver the Fed what they've finally been looking for, and that is a sign that inflation has peaked. I've given you the good, now here's the bad and the ugly. New export sales were down sharply in key markets. Foreign demand for U.S. manufactured products has dropped off due to a strong dollar and marked inflation. New export orders have declined the most in 25 years. A study of previous periods shows that a drop-off in demand for exports is a key indicator of an impending global recession. So while things are working in our favor right now, be aware of what we may see around the corner. Until the Fed signals that the fight against inflation has come to an end, be cautious of buying stocks while the S&P 500 is trading above that 50-day average, and keep some cash set aside for the worst case scenario. Let's talk technicals for a moment. Coming into the month of November, the most pivotal price point for the S&P 500 is going to be around 37.85. Now, as long as we're still trading above that level, we're still showing some upside bias. Our first point of resistance is going to be around 4,100. If we break above that level, we could see a lot of optimistic buyers, but the strongest point of resistance this month could be around 4,250. That's about a 750 point move from the October 13th low, and we would be asking for all of the global concerns to go away to be asking for much more. Now, if things start to work against us, we could see some support around the 3,700 level, but if we break towards 3,400 in a strong way, we could be looking at new lows on the year. Last line of support in November sits around 3,200 for the S&P, and that could mean that all things have gone wrong and the global recession has finally come to fruition. Manufacturing reports are behind us, so now we can look forward to the Fed's interest rate decision tomorrow, with non-farm payrolls and unemployment being reported on Friday, giving us insight on what economic activity looked like for October and what we may have to look forward to. If you're looking for some additional insight, I would also look at the trade balance report on Thursday. Any meaningful decline in exports could be signs that the global economy is starting to slow at a recessionary pace. Now, 80% of CEOs believe that there will be a European recession with adverse global effects. Over 10% believe the United States will have a deep recession of our own. Signs of cooling inflation and slowing economic demand could lead us higher, but signs that we're cooling a bit too much could be a one-way ticket to a brand new 52-week low. The main point of this particular episode has been to raise awareness. We may see some short-term upside, but we don't want to get too optimistic. When the S&P is trading above its 50-day average in a bear market, that is a sign that we may be overbought. And in a bear market, the best time to buy is when things are oversold and underpriced.